Welcome to Java. Thank you for joining me. It's January 13th, 2024. It is also Monday, so I hope everybody had a wonderful weekend. There is so much going on this morning, and that did happen over the weekend. If you had the opportunity to catch my one from yesterday, did cover a lot, and even since then, quite a bit has happened now. As you know, we are in a very precarious situation regarding not just the markets, but also the global economic issues going on right now. We've got the bond markets in an incredible situation at the moment. So with this, let's go ahead and start in with our favorite risk indicator, the MMRI. Now, it was in extreme territory yesterday when I spoke, and it's risen even since then. So 326.8. This is just truly significant. And if this does not calm down, I think that it will, but if this does not calm down, this could be a very, very serious issue going forward. Now, as I'm doing this, I just took another look at what is going on with the 10-year yield. Now, the two main components of this, if you're new here, it is the relative strength of the dollar, which is above 110 right now, crushing all other currencies in its way, and the 10-year yield. So the 10-year yield has been rising as well as other bond yields. And this is a significant issue for not just the stock markets, but everything else in its way. It's disrupting global trade as well. Now, as I was saying, it is retracing a bit as I'm doing this. So this somebody is jumping in and buying the dip. Is this the PPT? Is it the Federal Reserve? Is it foreign nations? We'll find out a little bit later, but at the moment it looks like it is retracing a bit. So the current status as it is, it has major resistance if you look at this on the chart at about 5%. So 4.786. It was a little bit higher not long ago, but it could rise more to that level. So with this, it's crushing pretty much everything in its path. We've got the fear greed meter because of this and the sell-off on Friday hitting that extreme fear territory now. We're at 26. So with this, the retailers feeling very uneasy about this sentiment. It is still bearish on the swings. Now, the stock market at the moment, all on the downside, with the exception of the VIX, which is the volatility index or the fear index, and oil. Now, oil is up on the Russian sanctions, so this has a significant increase in light of all this. Now, the surprise here really is gold not going a little higher than it is, but it is holding ground at 2,699.90. So just below that 2,700 level. Now, as I said, crude oil in the futures still up as well, and the futures taking some pressure as well. Now, I want to speak a little bit about cryptocurrencies. Bitcoin fell below that 92,000 level, and if this continues, it's showing weakness. So there's a bit further to go with this, could bounce, but at the moment we are now underneath that support level. So we'll watch what goes on with this. And this, saying that it's falling to the lowest it's been since November, and this is a broad risk asset sell-off. So with all of this kind of got a flight to safety going on, there is a lot of fear driving this market at the moment, but it's not at a severe level, although it is increasing significantly. So with this 10-year yield being so high, it is driving more throughout the world. This is a global issue. They're blaming it again on the jobs data. It's much larger than that, but if they want to blame that jobs data, that's fine. But we've got Treasury sell-off going off globally. So I don't know how they explain that globally our jobs would affect them, but that's the cover story. So want to bring this into light because we've got this story coming out, how psychological indicators can help you time the market. And this is about the volatility, which is the VIX. Now, the VIX is mean reverting. And trying to time the market is a new person's mistake in this market. I don't give financial advice, but I would not advise to do something like this. There is a saying for a reason that time in the market is much more important than timing the market. So trying to pull those tops and bottoms are usually what wipes out accounts, especially in severe moves like we are seeing. So just to give a visual uh, aspect of what's going on right now. So we've got, this is the stock market in general. We've got a few outliers like Meta, but for the most part taking hits. Cryptocurrencies right now deep in the red and going farther. So very weak with these. So the general consensus, stock traders rattled by the fresh rise in bond yields. They've been rising. And it's not so much the rise again, but the rate that it's doing it is significant. So these sudden increases, everything is a money flow. So it's flowing out of stocks and cryptocurrencies and going into safe haven assets at the moment, as well as oil. Now, the calendar. Today, not too much. 2 o'clock, the monthly US federal budget. Not expecting that to be a mover at all. However, tomorrow morning, prior to the market open, so Tuesday morning, we're getting some optimism, but really, it's the PPI, CPI that we will be looking at, those coming out 8:30 in the morning. These are inflation indicators. And the important part of these is that these are what the market's expectations of whether the Fed will cut or not, and that's what they're going by. Now, a few other things here, and I spoke about this when they came out with the quantum computer, the quantum chip with Willow. Google came out with Willow. Everyone was talking about how this is going to crush Bitcoin going on until Jensen Huang, who is the CEO of NVIDIA, said that it's not going to be practical for 10 to 15 years. So also had Mark Zuckerberg come out and kind of back that sentiment. However, with this, it crushed the quantum computer stocks in these, including QUBT, RGTI, Rigetti, and IONQ. These are some of the ones that took major hits on this. So just want to bring these up because trying to time that market again, these happen so rapidly. That's how they wipe people out. Okay, with this, we've got the continuance to the incoming administration. The inauguration date is next Monday. So Lockheed Martin is the latest, donating $1 million to the inaugural committee as speculation growing over the crackdown on traditional defense contracts. Now, this is a drop in the bucket to them, and it's nothing in comparison to the government contracts that they've had. So this is really just a token that they must do pretty much to continue business. However, it will be a larger hit to them if they do indeed initiate some peace deals, which are a possibility. So Lockheed Martin as well as some others could take a hit from that. So moving over, again, this kind of in with Europe, Germany is set for a dismal economic report card before their snap election. Well, whoever that's a surprise to hasn't been paying attention because Germany's been in trouble for some time, mostly on their swing and determination for that green energy policy, just absolutely kneecapped them as far as an economy. Okay, we've got China exporting now more to Vietnam than Japan for the first time as the supply chains shift. So we're watching this global move, and this is an underflow on the currency wars. So with the currency wars, you see it in in the relative currencies, but how that is balanced is through the trade. So this is really what's going on because China is doing quite a bit of easing, quantitative easing, in order to support their economy. This is the other side you see of it. Now, a few more things. We've got the LA fires. Everybody's talking about this, how it's going to cost everybody because it's going to hit insurance companies. It's going to go up to the federal level which means it's going to be covered through the taxation system. Now, this bond sell off, as I was saying, rocking the world, you might want to take the other side. Now, I do tend to agree with this. I think it's not quite the time yet, could go a little further. But once that bond yield gets a little closer to that 5%, that would be severe resistance. I think they are going to step in. They cannot allow this to continue or the destruction that will cause. And I don't think they're quite ready for that. Now, with all of these trade wars, just want to talk about Canada preparing to strike back hard, in quotes, hard, with retaliatory tariffs if Trump starts a trade war. Now, Canada is overtaxed at the moment. The imbalance through their taxation alone puts them at a severe misposition here. They're trying to put together a list that might actually have an effect on the United States, but really they don't have the position to go there, so to speak. I don't think they'll have to, but at the same time, this is just something they've got more issues with the currency, so they're going to have to balance that out through a different way. Now we've got the White House just issuing new artificial intelligence chip export limits. This is going to be larger. This is going to hit your chip stocks in the morning. Nvidia already taking a hit from this, but you're going to see that wide sector. And the chip manufacturers, of course, are against this. They are trying to slow the technology going over to China, but they're going to have to look at something else because, again, China already has enough of an equivalent technology, and they're going to balance this out with Taiwan and trade, everything else going through. So, because they do still trade with these other countries, regardless of the wars and everything else that they're talking about in the mainstream media. Now we've got US oil refiners bracing for a tough year as the investment sentiment turns negative. Well, they just got given a gift by the current administration because the new sanctions from the United States, Russia is saying that it will destabilize global markets. Well, it's going to swing around the US oil refineries because Europe needs this oil. It doesn't just stay in Russia, and it's not just going to hit their market. So this this is more of a global thing than people realize. A couple of things I would like to just go over, because what everybody is looking forward to is these rate cuts, quantitative easing. Now, the ECB, they also are looking at rate cuts. Now, the story they're floating out is they're unlikely to accelerate their rate cut pace. Well, you will. Because if the United States cuts their rates, you have to stay in tandem. The real story and the real thing that this should say, how it should read, is that the ECB is simply waiting for the United States to cut first. Because once the United States cuts their rates, it opens the door. They are right now being crushed through the strength of the dollar, so they cannot cut right now. So, with all of this, it's kind of going back to that global currency and seeing what's actually going on behind all of this. And here is the real story behind the whole thing. This is the ECB's chief economist warning of too low inflation if rates stay high. So they must cut the rates. And why is too low inflation a problem? This is because if we just change out the words here, because I like to use words to manipulate these things, too low inflation, you can substitute that for deflation or more severity, depression. So this could start that doom loop that if inflation drops too much, businesses will have to cut jobs. More jobs, more unemployment. That leads to lower spending, and it pushes it into that doom loop of a severe depression that they cannot control. So they can control inflation much more easily than they can control deflation, or as they're saying, because they don't want to spark panic, they're calling it too low inflation. So now we've got the 2L inflation. That's what we're going to start mimicking this. So with this, wish you all a great trading day, wonderful day in general, of course, my friends. Until I see you again, stay free.